Hey everyone, if you're looking to be first in line for deep dives on specific tickers, make sure you like and subscribe to the stockanalytics.ai YouTube channel.
Yeah, it helps us out a lot.
It really does. And our members, it's just $4.99 a month. They get priority access to these in-depth analyses.
Mhm.
And truly, by the end of this deep dive, you'll understand exactly why that matters for today's subject.
Definitely.
Today, we're cutting through the noise, trying to get you informed fast. We're diving deep into Caris Life Sciences, Inc.
Yep. Ticker CAI.
That's the one.
Yeah.
Just debuted on the NASDAQ, valued in the multi-billions, and built squarely on this promise of AI-driven genomics.
And the central question we're unpacking today is, well, it's a big one. Can this powerful data moat, this, unique competitive advantage Caris seems to be building, can it actually translate its undeniable scientific promise into durable long-term shareholder value, especially now in the demanding post-IPO world? So we'll provide a comprehensive expert-level analysis. We're anchoring it to its first day of trading. That was June 18th, 2025, when it closed at $28.
Yeah.
This deep dive is really for you, the curious learner, who wants to grasp the full picture of a cutting-edge company, quickly and thoroughly. Get ready for those aha moments connecting the science to the financials.
Okay, let's truly begin our exploration. This is part one, the foundation of Caris Life Sciences.
Let's do it.
And we'll kick things off with chapter one, business analysis.
Right.
So what exactly is Caris Life Sciences at its core? I mean, they position themselves as a next-generation AI tech bio company and precision medicine pioneer.
That AI tech bio label is key, isn't it?
It really is. And what's particularly compelling here is their concept of a virtuous cycle. Imagine this. Every single test they perform enriches their already massive database. That data then fuels their AI to discover brand new insights, which, leads to better products, increased adoption by doctors.
Better adoption.
And, you guessed it, even more data. It's like this self-reinforcing loop, a compounding competitive advantage that really underpins their whole vision.
And that AI tech bio framing, as you said, it's absolutely crucial. It justifies a valuation that, frankly, traditional diagnostic companies just wouldn't get.
No.
They're not just seen as a lab with high operational costs. They're viewed as a scalable software and data play that commands a premium, right? Because it's priced on future innovation, not just selling today's tests.
Exactly. So where does the money come from?
Okay, revenue. Two main streams currently. First, their foundational business. Molecular profiling services, basically selling sophisticated diagnostic tests like MI Profile and Caris Assure directly to oncologists.
Standard enough, but advanced tests.
Right, but here's where it gets really different. The second stream, pharma research and development and data services.
Ah, the data licensing part.
Precisely. Partnering with biopharma companies, licensing their huge, de-identified clinicogenomic database and their analytical tools. This is all about accelerating drug discovery. That's where the AI really flexes its muscles in a B2B way.
Okay, let's break down those key products then. Their flagship, it's tissue-based, called MI Profile.
Right.
And this isn't just a simple test. It's incredibly comprehensive. It combines whole exome sequencing, WES.
Which maps the protein coding DNA.
Exactly. And whole transcriptome sequencing, WTS.
Which checks the RNA, sees what genes are actually active.
Right, like a blueprint and a real-time activity monitor for the cancer. Plus, protein analysis, it's a lot.
It is. And within that, they have MI Cancer Seqa. That's their FDA-approved companion diagnostic.
Which is a big deal, regulatorily speaking.
Huge deal. FDA approval means better reimbursement rates, wider adoption. It's a significant asset.
Then there's Caris Assure. That's their blood-based liquid biopsy, launched early 2024.
Relatively new, yeah.
And its crucial differentiator, they say, is this proprietary method for filtering out something called clonal hematopoiesis, or CH mutations.
Yes, the CH filtering, that's important.
Why is that so important?
Well, CH mutations are common, especially as people age. They're in blood cells, not necessarily the tumor. But they can look like cancer mutations in a liquid biopsy.
So false positives.
Exactly. Filtering them out makes Caris's liquid biopsy results potentially much more accurate and reliable, less noise.
Gotcha. And beyond just finding mutations, they use their data for AI algorithms, right?
Right.
Like Caris First diet.
Yeah, that one predicts how a patient might respond to specific chemotherapy.
And GP-SIA.
That's their genomic profiling similarity score. Think of it like finding genomic twins to predict outcomes. These are high-margin, very scalable tech plays, pure data products.
So this leads us to Caris's market position and, well, their scale. It sounds impressive.
It really is. This company is a formidable leader. As of March 2025, get this, over 6.5 million tests processed on more than 849,000 patient cases, generating a staggering 13 quadrillion data points.
13 quadrillion.
Yeah.
That's hard to even imagine.
It is, and that sheer volume is the bedrock of their competitive moat. It's incredibly difficult to replicate.
And they have that network too, right? The POA?
Right, the Caris Precision Oncology Alliance, or POA, a network of 96 leading cancer centers, including 45 NCI-designated centers. That's huge for driving adoption and building credibility. It basically funnels more cases, more data, back into that virtuous cycle.
So wrapping up the value proposition, for doctors and patients, it's about getting the most complete molecular picture for personalized treatment.
The best possible blueprint.
And for their biopharma partners.
It's a platform to speed up and, importantly, de-risk drug development using unique, large-scale, real-world data that nobody else really has in the same way.
Okay, let's connect this to the bigger industry picture.
Right. The trend is undeniable. A fundamental shift towards precision medicine and oncology. AI and big data are the key catalysts here.
No question.
Which naturally leads us to ask, how big is the market they're actually going after?
Good question, and Caris has an answer. They estimate a total addressable market, the TAM, of roughly $150 billion.
$150 billion just in U.S. oncology.
In U.S. oncology alone, yeah, and they break it down. Therapy selection, tracking minimal residual disease or MRD, early cancer detection, and those biopharma services. It's a truly vast runway for growth.
Okay, huge market, but it's got to be competitive.
Oh, fiercely competitive. You've got Caris with their AI-driven multimodal approach.
Then Guardant Health, probably the leader in liquid biopsy historically.
Right. Tempus AI, another big AI and data platform.
And Foundation Medicine, which is owned by Roche, so they have big pharma backing.
A crowded field. So how does Caris claim its edge?
They really emphasize that multimodal approach combining DNA, RNA, protein data, plus the database scale, the deep AI integration, and as we discussed, the accuracy of their liquid biopsy with that CH filtering tech.
Okay, makes sense. Now, what about the regulatory maze they have to navigate?
Yeah, complex is the word. It's mainly governed by CMS through CLIA standards for labs and the FDA, which oversees medical devices. But the big evolving area is laboratory-developed tests, LDTs.
Right, you mentioned that uncertainty.
Exactly. Historically, the FDA kind of let labs regulate themselves under enforcement discretion, but they've been trying to clamp down, regulate them more like medical devices.
But didn't the court just throw a wrench in that?
Precisely. A U.S. District Court ruling in March 2025 actually vacated the FDA's final rule on LDTs. So massive uncertainty. The whole debate is basically punted to Congress now. This could have huge implications for Caris and others who rely heavily on LDTs.
So regulatory risk is definitely high on the list.
Absolutely. And it just adds to the already massive barriers to entry in this market.
Like what else?
Well, the sheer scientific and tech complexity. You need serious brain power.
Right.
Then the massive capital investment needed. Caris itself, as we heard, deployed $1.86 billion since 2018 just building this thing. Yep. And then there's the data moat. It's not just having data, it's having linked genomic, proteomic, and clinical data, constantly learning, that's almost impossible to replicate quickly.
Right, the self-improving engine.
Exactly. Add regulatory hurdles, reimbursement complexity, and the long time it takes to build trust with doctors and payers. It's a tough business to break into.
Okay, given those barriers, what really allows Caris to have a defensible position? Their brand seems strong.
It is. Built on over 1,000 peer-reviewed studies, which is impressive academic validation, and that POA network adds immense credibility.
But they're not profitable yet.
No, not yet. That's typical for this stage, heavy investment phase. But their scale, over 6.5 million tests, certainly suggests potential for future economies of scale. If they hit profitability, the margins could improve significantly.
And the core advantage.
It really comes back to that powerful data network effect. Every test adds data, makes the AI smarter, improves products, enables new ones, attracts more partners.
The virtuous cycle again.
It is. It creates this self-reinforcing loop, building a formidable compounding moat. Their vast integrated data asset is their most defensible advantage. Plus, those unique assets you listed. The multimodal database, the AML platform, MI Cancer seeks FDA approval, the advanced liquid biopsy with CH filtering.
Okay, a really strong foundation laid out there. Let's shift gears now to the people behind it. This is Chapter 2, Management evaluation.
Right, leadership.
Yep.
Always critical.
And here it really centers around the founder, chairman, and CEO, David D. Halbert. He's got a serious track record, a proven serial entrepreneur. He founded Advanced PCS, sold it for $7.5 billion.
Delivered something like a 150-fold return to investors.
Exactly. That suggests he knows how to scale businesses, like massively. And there's a personal story, too. His motivation came from his mother's battle with cancer. Adds a layer of purpose.
That founder-led structure, driven by someone with that kind of track record and personal mission, it's definitely a positive for consistent vision. But
There's always a but.
there's substantial key person risk, isn't there? The company's strategy, its culture, it seems so deeply tied to Halbert. What happens if he steps back?
That's a fair question. Though they have built out an experienced team around him, David Spetzler as president CSO, George Sledge Jr. as CMO.
True, experienced lieutenants. And while they're new to the public markets, so no public crisis response record yet, navigating that whole LDT regulatory mess pre-IPO shows they can handle complex external challenges.
What about transparency and ethics, being newly public?
Well, their public history is short, obviously, but the S-1 registration statement filed for the IPO provides a pretty detailed look. Halbert consistently talks about a patient-first philosophy.
And the Caris Foundation.
Right, a nonprofit supported by his family. It reinforces that ethical, patient-centric image. As far as we can tell from public info, no ethical red flags have popped up.
How are they putting their money to work? Capital allocation?
Their history screams aggressive internal growth. That $1.86 billion deployed since 2018 went straight into R&D, lab expansion, building out that data infrastructure, pure investment in the core business.
And the IPO money. About $494 million raised.
Yep, and it's clearly earmarked. More R&D, expanding operational capacity, growing the sales force and commercial footprint. It's all fuel for the growth engine.
So no share buybacks or dividends anytime soon, I take it.
Definitely not. They're a high-growth company. Any future earnings, if and when they come, will be plowed right back into the business for more expansion.
Okay, so that brings up return on invested capital, ROIC.
Yeah, and right now, it's deeply negative. Not really a meaningful metric at this stage.
Expected for a pre-profit, high-growth company investing like crazy.
Exactly. The whole investment thesis isn't about current returns. It's about the potential for really high ROIC down the road once they hit scale and profitability.
So what should investors look for instead? Leading indicators.
You'd want to see sustained, strong revenue growth, obviously, improving gross margins over time, showing some operational leverage, and critically, signing new significant biopharma partnership deals. Those data deals are key.
All right, let's get deeper into the financials then. This is Chapter 3, Financial Analysis. Time to crunch some numbers.
Okay.
Market cap first. As of June 18th, 2025, close of day one, around $8.18 billion.
So straight into large cap biotech territory, significant valuation right off the bat.
And the revenue growth. We touched on it, but let's get specific.
Powerful and accelerating. Total revenue grew almost 35% from 2023 to $412.3 million in 2024.
Strong growth.
And even better, Q1 2025 revenue hit $120.9 million. That's a 50% jump year over year. Real momentum there as they scale.
Okay, top line looks good, but the bottom line,
That's
the challenge, right? Profit margins.
Yeah, currently negative across the board because of those heavy investments. Gross margin for the last 12 months, LTM, is okay at 46.35%. Not bad for diagnostics.
But operating and net margins.
That's where the investment hits. Operating margin, LTM, is minus 49.25%. Net profit margin, LTM, is minus 82.02%. They lost $281.9 million in 2024 and another $102.6 million just in Q1 2025. Burning cash.
Which shows up in free cash flow too, I assume.
Absolutely. Free cash flow is significantly negative, negative $212.01 million LTM. That reflects the operating losses and the ongoing capital spending. It really highlights why that IPO was strategically necessary. They needed the cash to fund the growth.
So financial stability, history of losses, but maybe signs of improvement.
Exactly. Consistent losses are the story so far, but you are seeing signs of improving operational leverage as revenue climbs. Suggests profitability could eventually be within reach if growth continues and costs are managed.
Now, I saw a really striking number, debt to equity.
Ah, yes. It's managed 106.4%. Deeply negative.
Why so negative?
It's primarily because their shareholder equity is negative, over to negative $2.6 billion. That happens when accumulated losses wipe out the initial investment and retained earnings. Combine that with $376.74 million in total debt.
So negative equity means liabilities exceed assets. Sounds fragile.
It does look fragile on paper. It signifies heavy investment and a lack of profitability to date. The balance sheet is definitely sensitive. However, their current ratio short-term assets divided by short-term liabilities is 2.13.
So they can cover their short-term bills.
Yes, it suggests adequate short-term liquidity, especially with the fresh IPO cash buffer. They're not about to run out of money tomorrow.
Okay, valuation. PE is useless with negative earnings. So price to sales.
Right. We look at PS Caris trades at around 18.1x PS.
How does that compare?
It's a significant premium. Guardant Health is around 8.1x, Tempus AI maybe 15.1x.
So the market is paying up for Caris. Why?
Seems like clear optimism about their future growth potential and that unique multimodal data asset. The AI story is commanding that premium.
What about intrinsic value, like a DCF?
A discounted cash flow model for a company like Caris is, well, highly speculative. You get a very wide range of potential values.
Because the inputs are so uncertain.
Exactly. Key assumptions like future revenue growth rates, the discount rate you use, which needs to be high, maybe 12–15%, given the risk and what their operating margin might look like if they reach stable profitability, they are incredibly hard to predict accurately.
So the DCF mostly highlights the risk-reward.
Precisely. It underscores the high-risk, high-reward nature. Huge potential upside, but also significant downside if they don't execute flawlessly.
Okay, we've built a solid picture of the company itself. Now let's zoom out. This is part 2, market dynamics and future outlook.
Right, how the market sees it, ownership, risks.
Let's start with Chapter 4, market sentiment. How's Wall Street feeling about CAI?
Well, officially, it's quiet. As of June 19th, 2025, no official analyst ratings or price targets yet.
The quiet period.
Exactly. They just IPO'd, so underwriters are restricted.
Yeah.
That mandatory quiet period expires on July 28, 2025. Expect a flood of ratings then.
But what about the unofficial buzz? Media sentiment.
Overwhelmingly positive. Very bullish, actually. The focus has been all on the successful upsize IPO priced at $21, surged 33% on day one.
Framing them as an AI leader.
Totally. The narrative is AI-driven healthcare revolution, and Caris is positioned as a pioneer. Very positive spin so far.
What about technical indicators? Short interest, moving averages.
Too early. Stock's only been trading for a day or so. No meaningful data on short interest or moving averages yet. That stuff will become relevant in the coming weeks and months as a trading history develops.
Okay, let's move on to who actually owns the company. Chapter 5, ownership structure.
Right. This is interesting. Pre-IPO, institutional ownership showed serious confidence. You had giants involved. Sixth Street Partners, T. Rowe Price, Fidelity, Coatue, Millennium Management.
Big names. Any buying into the IPO itself?
Yeah, notably, Neuberger Berman expressed interest in buying a substantial chunk of the IPO shares. That signals continued institutional belief even at the IPO price.
Okay, but what about insiders, management, early investors?
Now here's where it gets really impactful for public shareholders. Insider ownership is highly concentrated. Executive officers, directors, and the big principal shareholders collectively control about 63.6% of the voting power.
Wow, over 63%. So it's basically
a founder-led kingdom, essentially. Public shareholders, despite putting in capital, have very limited influence on strategic direction, board compasses, stuff like that.
So buying the stock is a direct bet on David Halbert's vision and execution.
Absolutely. It's his ship to steer. Now, insiders are also subject to a 180-day lockup period until December 15th, 2025.
So they can't sell their shares immediately.
Right, which aligns their interests with new shareholders, at least initially. But that high concentration, it's a classic double-edged sword. You get strategic stability, potentially faster decision-making.
But fewer checks and balances, less accountability to public owners.
Exactly. High control, low influence for outsiders.
Okay, that's crucial context.
Yeah.
Now let's formally assess the dangers. Chapter 6. Risk assessment. Time for a SWOT analysis.
All right. Let's break it down. Strengths. We've covered these. Dominant proprietary data moat. Advanced AML. Visionary founder-led management with a track record. Established commercial footprint and brand via the POA. And those dual revenue streams, diagnostics and pharma data.
Solid strengths. Now, weaknesses.
History of significant net losses, high cash burn, that fragile balance sheet with negative equity we discussed, the key person dependency on David Halbert, and importantly, critical sole source supplier concentration. They rely heavily on Illumina for sequencing tech and reagents.
That Illumina dependence could be a real choke point.
It definitely could if anything disrupts that supply chain.
Okay, opportunities.
Huge ones. That massive $150 billion plus TAM in U.S. oncology alone. Potential to expand into new clinical medical areas, maybe cardiology, neurology, using similar genomic AI approaches, growth across the cancer care continuum, early detection, MRD tracking, and crucially, scaling those high-margin biopharma partnerships. That data licensing is a big opportunity.
And finally, threats.
Intense and evolving competition, lots of smart people and money in this space. That regulatory uncertainty around LDTs is a major overhang. Reimbursement risk, getting payers to consistently cover these advanced tests at good rates. The pace of market adoption, how quickly doctors integrate this into practice, and specific geopolitical risks.
Okay, let's pause on those broader risks. How do macroeconomic factors like interest rates and inflation hit a company like Caris?
They hit hard, especially for a high-growth, currently unprofitable company. Higher interest rates mean future debt costs more, obviously. But they also increase the discount rate investors use to value future potential earnings.
Pushing down the valuation.
Right, and persistent inflation. That can squeeze them too. Increases costs for labor, supplies, reagents, further compressing those already strained margins. It can also just make the whole investment climate more risk-averse. Investors might shy away from cash-burning growth stories.
And you mentioned specific geopolitical risks.
Yes, specifically the U.S. imposed tariffs of 2025. Remember that sole source dependency on alumina? Alumina imports a lot of equipment and reagents. These tariffs are expected to significantly increase Caris's cost of services. That puts direct pressure on their gross margins, could accelerate their cash burn even faster.
So it makes it more expensive for them to run the tests that build their data moat.
Exactly. It creates a really difficult strategic dilemma for management. How do you keep building the moat affordably when your key inputs are getting pricier due to trade policy? It's a significant headwind.
Okay, a lot to consider there on the risk front. Let's bring it all home now with Chapter 7, Conclusion.
Let's synthesize.
So let's lay out the bull case for Caris Life Sciences. What's the optimistic story?
The investment thesis is definitely a compelling high-growth narrative. It fundamentally rests on that dominant, defensible, self-improving data moat.
Guided by
A visionary founder with a proven track record of massive scaling, targeting a truly enormous addressable market, showing accelerating revenue growth already, and clear technological differentiation through their multimodal AI and that advanced liquid biopsy. It's a bet on disruption.
Okay, sounds good. Now, flip side, the bear case. Why might investors be hesitant?
The bear case highlights pretty significant financial, competitive, and regulatory risks. There's that long history of unprofitability, high cash burn, leading to a fragile financial structure with negative equity.
The valuation premium.
Right, a high valuation already trading at a premium to peers, pricing in a lot of future success, intense competition that isn't standing still. That LDT regulatory uncertainty is a big cloud.
In the ownership structure.
High insider ownership limiting public influence. Plus that critical sole source supplier risk with alumina, now potentially exacerbated by tariffs. Lots of hurdles.
So the valuation again. Intrinsic value is hard to pin down, you said.
Extremely difficult. An educational DCF, as we discussed, spits out a very wide range. It just reflects the huge potential upside versus very real downside risk.
So that $28 closing price on day one.
It clearly reflects very high expectations. The market is pricing in a very optimistic scenario, essentially demanding near flawless execution from management going forward.
So summing it up, as of June 19, 2025, Caris at $28.
It's definitely on the higher end of what you might call fair value, maybe even arguably stretched, predicated on ambitious goals. An investment in CAI is fundamentally a high-risk, high-reward proposition.
A bet on?
A clear bet on a visionary founder, that powerful data moat, and the truly transformative potential of AI in healthcare. But
the caveat.
You, as the investor, must accept a potentially long and uncertain path to profitability. Future success really hinges on their ability to translate all this incredible scientific promise into a sustainable, profitable business model. That translation is the key challenge.
This deep dive into Caris Life Sciences really highlights that exciting but complex dance, doesn't it, between groundbreaking science, huge market potential, and the, well, harsh realities of financial execution.
It really does. Science versus spreadsheets, in a way.
So as you consider companies like Caris, you really have to ask yourself, how much are you willing to bet on that future promise of data and AI versus current tangible profitability? And maybe more importantly, what specific indicators would truly signal to you that they are making that pivot, that they're turning the corner towards long-term value creation in the years ahead?
Good questions to ponder.
Definitely. And don't forget, if you want to request your own deep dive on a specific stock ticker or just get more in-depth analyses like this one, Make sure to like and subscribe to the stockanalytics.ai YouTube channel.
Yeah, and remember, members get priority deep dives, just $4.99 a month.
That's right.
And the necessary disclaimer. Remember, this analysis was generated by an AI system. It's for educational purposes only. It should definitely not be considered financial advice.
Please, always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. Your capital is your responsibility.